Macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen. Well, with the big rally in the stock market after the Cliff deal, the question now is, do the bears still have a case at all? Or is this going to merely become a bull trap? With the answers to these and other pressing questions, our tactical trader Kevin Cook is here with us. And hopefully can shed some light on this situation.
I have a lot of friends, professional traders, who are very bearish here. Big 5% rally, and they're just itching to short the S&P above 1450.
So do the bears have anything to growl about?
You know, if you look at the fiscal cliff deal and say, well, God, was that any reason to rally in of itself? You know, what really got done? Mm-hmm. You know, Congress functioned, but are we cutting the deficit? You know, are we improving the long-term fiscal situation for the U.S.? Yeah, I mean, the answer is no. But the point they miss is that the market wants to go higher, and institutional investors want to get fully allocated. They were just waiting to get this out of the way. So there was a lot of pent-up demand, as we talked about.
So really what the deal represents more than anything is certainty.
Yeah, exactly. Yeah, just give us something. It's like, I don't care how bad the deal is, but just tell us, you know, what our tax rates are going to be, et cetera, going forward. And a lot of that was getting cleared up. You know, I looked at the rally on Monday, December 31st. The market was already rallying without certainty of a deal. Just, you know, that this is going to be over soon. And in fact, that was the last day for tax gain selling, dividend selling.
Yeah.
Let's look at a couple of charts to show, you know, the S&P is up to 1460, but that's resistance. You know, those were the tops that we saw earlier this year.
Right.
So the bears do have a case there. But let's not look at, I'm not going to look at the Dow. The Dow is the weakest index, 30 stocks there. The S&P 500, I mean, you could really look at the top 100 stocks, the OEX, you know, not breaking out to new highs. Let's look at the other 2,500 to 3,000 stocks that are stronger. Let's take the Russell 2000 first, making new all-time highs. The black line I've drawn is 868. Made those highs in 2011. Just touched that high within, you know, fractions of a point again this year. Came off, and now we're through there above 870. So there's 2,000 stocks breaking out to new highs.
Okay.
Then the mid-cap 400, the S&P mid-cap 400, made its all-time high earlier this year at 1,030. Now we're above 1,045. So there's 2,400 stocks right there that are strong, while the big caps, you know, the div payers, you know, got sold. So that's breadth and depth for the market, and that's encouraging if you're a bull to see these indexes making new highs.
All right. So is there a specific chart then that your bear friends might be keying in on?
Yeah, there's one. Yeah, we'll take a look at a couple here. This is new highs minus new lows on the New York Stock Exchange, and that last spike up in September over 1,000. What did that lead to? That was a market top, and we just proceeded lower from, you know, say 1475 in the S&P all the way down to 1340. Well, here we have another spike up over 1,000, and so a lot of bears are pointing to this new highs, new lows dynamic that, you know, this is way overdone. This is a top, but we need to look at it in different perspectives. So here I'm showing a weekly chart. So we're going back 3 years, and put a rectangle around the bulk of the rally in 2010 into early 2011. New highs, new lows, made some spikes and just kind of went sideways, and the market gravitated higher. And you can see the same thing for early 2012. Strong rally, and you got some spikes in new highs, new lows, went sort of sideways, but the market can continue higher. So these new highs, new lows, they're not going to trend. And so, yeah, new highs, new lows could fall back, but the market could keep lifting higher. Here it is on a rolling 5-day basis for the past 3 years. And you can see we're not even up to the levels of last September. So this is, there's several ways of looking at this data, but when you're looking at a broad index like the New York Stock Exchange and looking at new highs, new lows on it, new highs minus new lows, you know, you get an idea of breadth, and what's in store. So this is something we'll keep an eye on.
Okay. So inquiry minds want to know then, are you calling for new highs above 1565 on the S&P?
On the S&P. This year, I think that I'll give that a 60% chance of new highs there, 1565. I think we'll definitely see S&P 1500 this quarter. Now the bears say, no way. This is the place to get short. This market is not going to get above, but that's actually part of the fuel that will take it higher. I mean, and if somebody just wants to talk about the fundamentals, what are the fundamentals, underneath the earnings that would sustain the market higher? We're stuck between 1% and 2% growth, and the fiscal cliff deal we did get will have an impact on first quarter GDP. But we're sort of in this new normal where 1% to 2% growth is still good for the market, and it's about as good as we can expect. It's much better than the boom-bust extremes. This is something that Kevin Matras has talked about. Maybe that we can live in this 1% to 2% GDP growth. We've got the Fed on our side, and then look at the alternatives. Where else are investors going to put their money? The bond trade, flight to safety and a place to park money, but it's not a place to get a return. And commodities are too volatile. Equities, especially when you look at the small caps and the mid caps,
Right.
there's a lot of place to put your money. I just want to look at a couple of my notes here. I wanted to talk about that. Everybody says, well, the market did so well in 2012. Let's say a 15% return, depending on which index you look at, 12 to 16%.
Yeah.
But 2011 was zero return for the S&P 500. You opened at 1250-ish and you closed at 1250-ish. So in 2 years, with all this policy, all the policy headwinds from Washington, the market only returned about 15%. And you've got money managers with money to put to work in equities that will continue to drive this higher. So that's why I think we see S&P 1500 this quarter. It's not that we're not going to have pullbacks. Maybe we need to go back down and test 1440, but that'll be a dip to buy, in my opinion. And I'm not gloating as a bull here that I had it all right, because in one sense I was underinvested. I only got to 70% long by Monday morning, and so in a sense I missed a good chunk of the rally too. I should have been 125% long, but we've got confirmation here of strength in equities on a broad base, and with China ready to reflate, Europe stable, and the U.S. Recovery on some firm footing with the Fed at its back, that's my case for higher stock prices here.
Okay. Our market timer, Kevin Cook, and you can read other things that he writes on our website, Zacks.com, if you're not already there watching this video. With Kevin, I'm Terry Ruffalo.